Welcome to the Wall Street Lab podcast, where we interview top financial professionals and deconstruct their practices to give you an insider look into the world of finance.
Hello and welcome to another episode of the Wall Street Lab podcast. Today we have for you Dan Houlihan. Dan is an Executive Vice President and Head of Northern Trust Asset Servicing for the Americas. Prior to joining Northern Trust, Dan spent 19 years in numerous leadership positions across several companies in the investment management, technology, and service space. He currently serves as chairman of the board for the National Investment Company Service Association, or NICSA, and as a director on the Advisors Investment Trust. We talk about the asset servicing business and its various components like custody, fund administration, investor servicing, and outsourced solutions across the front, middle, and back office. We touch on trends in the asset management industry in regard to outsourcing and technology, and last but not least, about diversity in the banking industry. If you like this episode, please leave us a 5-star review on Apple Podcasts or wherever you get your podcasts from. And now, without further ado, our interview with Dan Houlihan. Hey Dan, pleasure to have you on. Welcome to the Wall Street Lab.
Yeah, thank you. Thanks for having me.
Can you tell us a bit about your background, lead us a bit through your work experience? What are you doing?
Yeah, sure. So currently I'm the head of asset servicing in the Americas for Northern Trust Corporation. And I've been doing that. Well, I've been at Northern for about 11 years. Prior to that, I ran a consulting firm, was one of the founders of a firm called CitySoft, which is still around, but still provides consulting around operations and technology for financial institutions. And prior to that, I worked more in the technology sector for Thomson Financial around their trading and portfolio management systems, and then originally grew up in investment operations.
So that's a very wide range.
Yeah, it is. But it served me well, having the consulting background and the operating background is obviously directly applicable to what I do today. So
perfect. That brings us right to the topic. What are you doing today? I've been in finance myself for a bit, but I have no familiarity with asset servicing.
So I work for Northern Trust, which is obviously a global bank, and we're considered what's called a trust bank. And we have three main business lines. So we've got a large wealth management business that looks after high net worth individuals, families. And then we've got an asset management business called Northern Trust Asset Management, which is close to $1 trillion in assets under management. And then there's the asset servicing side of the business, which is what I run. And what we do there is the core of it is what's called custody, which is really the safekeeping of assets, both cash and securities for global investment managers, as well as large institutions for their pension assets, for example. So custody is one piece. Another large piece is what we would consider to be fund services. So that is the fund accounting and fund administration for different types of pooled funds or investments. So in U.S. nomenclature, it would be things like registered mutual funds that you'd buy from a Fidelity or Vanguard. In European terms, it's UCITS, which are usually domiciled out of either Dublin or Lux. And then there's lots of different unregistered products that are funds as well. So we do fund accounting, which is the calculation of the price of that particular fund on a daily or monthly basis. So for a U.S. mutual fund, every day there's a price published on the exchange. Our responsibility in that process is to calculate the overall price of the mutual fund by looking at the prices of the underlying positions that are held in that fund, as well as the daily flow of cash for subscriptions and redemptions. And so we then are accountable and responsible for striking that price, what is called the net asset value, accurately and on time each day and publishing it to the exchanges. Another product or business line that we have is called transfer agency or investor servicing, which is if you call a mutual fund company to buy a particular mutual fund or redeem shares, we've got a call center. And so firms will outsource that function to us where we deal with their end clients and their needs by way of redeeming or buying new shares, as well as the shareholder reporting that goes off of the investor servicing and tax reporting to the investors if it's taxable, if they're a taxable fund. And then we do middle office outsourcing as well for large financial institutions or asset managers. So that is essentially a service where we do everything after the trade. So let me use Fidelity as the example again. If the portfolio manager of a mutual fund decides to buy or sell a security, they will do that in the market. And then when we provide middle office outsourcing, they'll do everything after we do everything after the fact. So matching and confirming and settling the trade, doing performance and analytics on the performance of the portfolio. So that's a big business line for us as well. And then we do other banking. So the banking function reports to me to the extent that we distribute banking products, credit through our client channels. And the types of clients that we serve are very varied. We support asset managers of different types and shapes. So everything from private equity firms to hedge funds to traditional institutional managers and mutual fund companies. We also provide services to what we call asset owners. And those could be large corporations and their pension assets, for example, could be university endowments, can be sovereign wealth funds. So our client base is quite varied and quite global. And as you can imagine, the types of assets that we're dealing with oftentimes are quite complex. So there's a fair amount of complexity that goes into what we're doing. Hopefully that's a decent picture of what we mean by asset servicing.
Yeah, absolutely. That gives, I think, a lot of details that we could dive into. Let me just start by asking, you described all those different types of clients, traditional fund managers, institutional private equity, hedge funds, and all those. Mm-hmm. And what I'm thinking about is when you do the fund accounting, so you calculate the net asset value, is that for all of those? If, for example, in private equity, it's very difficult to probably do that, right? Or in hedge funds where they do very frequent trading. Is this something that those clients want from you, or is it more on a mutual fund only?
Well, no, it's not just mutual funds. There are other pool vehicles like in U.S. nomenclature, Delaware statutory trusts. There's different kinds of offshore fund structures. So, the net asset value, that's really applicable to publicly traded mutual funds or fund products, but it does translate into the non-registered side. And so the needs are different, as you point out. So a hedge fund doesn't have generally speaking, the daily liquidity that a publicly traded mutual fund would. So those might be valued on a monthly basis. And so that's part of, as we take on a new client, we work through and agree what the NAV calculation frequency needs to be and just the overall valuation process. So it's variable depending on the type of asset manager and the type of fund.
What might be the difference in the type of calculations? Do you have like a set of models, or would every fund manager come with their own model of how you should calculate this net asset value? Is there like a certain industry standard that you use?
Yeah, there's definitely an industry standard, particularly with publicly traded mutual funds. I mean, we're using the market. We get fed market pricing. The pricing source is agreed with the client, and on the publicly traded side, it's fairly consistent. The NAV calculation is the same. You're looking at the value of the underlying securities and the net flows to come up with the end of the day market price. So yeah, it's pretty standard.
And why is there a trend, or did you see a trend in asset managers outsourcing this? Is it a kind of third party, like another set of eyes that can control it? Or is it more a technical and cost problem that they don't want to have the knowledge in-house?
Yeah, no, that's a great question. I'd say, let me explain it in historical context, I guess. So if you look at an asset manager, different firms have different schools of thought, but many don't see the actual NAV calculation as a core competency of the investment manager. Their core competency really is picking stocks and bonds and delivering investment performance to their clients. And so leading up through the 90s, 80s and 90s, pretty much most firms outsourced what's called in our nomenclature, again, the back office, which is really the custody and the fund accounting piece, because there are scale providers like us who can do it, at least conceptually, better and cheaper and at scale than a single investment manager could. So whilst there are firms that still do fund accounting in-house, most have outsourced that through the 90s. And then what happened was 2000, the tech bubble burst, and we saw what we call the second wave of outsourcing. And that's when things moved up to the middle office. So the back office had already been outsourced. When the tech bubble burst, and then in particular in 2008, when the financial crisis hit, there had been a decent bull run, and that those bull runs can enable higher fixed costs. And so when we see a down market cycle, we generally see an uptick in the demand for outsourcing as firms look to move to a variable cost model as opposed to a fixed cost. So middle office became very popular from an outsourced perspective in, starting in 2000 really, but then again, a spike in demand in 2008, and the acceptance of that continues to accelerate. So I think now the last stat that I saw is that roughly 25% of the industry, global industry, from an asset manager perspective, have outsourced the middle office, and we expect that trend to continue. And interestingly, we've been on a bull run now for 11 plus years. And I'm not an economist, so I'm not going to predict when the next cycle will happen, but it likely will. And we fully expect that we'll see another wave of outsourcing, if you will. And our expectation is that this time around, the front office actually will not be as immune to cost cutting as it historically has. And by the front office, I mean the portfolio management function and the trading function, et cetera. So we're already seeing a trend in the marketplace where asset managers are outsourcing the entire trading function. So not just the execution of the trades to a third-party broker, but eliminating the trading function and moving that over to firms like Northern.
Excellent. And you actually took away my next question because while while preparing for the interview, I was wondering, what is front office outsourcing and what do asset managers still do if they have outsourced their front, their middle, and their back office? What do they focus on then?
Yeah, the front office is, look, different people would may describe the front office differently, but I would characterize it as this. If it's a distributive asset manager, meaning an asset manager that is trying to gather more clients and grow assets, then, I would argue that the core competencies of the firm are, one, gathering assets and servicing clients. So you've got a sales function and a client service function. And then obviously the investment decision making, which is the portfolio management and research function, which is heavy on the technology side as well. So you've got lots of different analytic systems that will help research analysts and portfolio managers with their decision-making, what-if analysis, historical analysis to evaluate model portfolios before putting them into real practice. There's compliance systems, there's order management systems. So a lot of that I don't think is going to go away because obviously that's the core of what they do and that's the value add to their clients. That said, a function like trading, not every firm will outsource it. There are lots of quant shops and high frequency trading firms that simply would never outsource the trading function. But the question becomes how much value add and how much actual investment return is being generated through the trading function itself. And again, because these are expensive functions, what firms are just doing more and more is to ask the same question that you just asked me, which is, okay, what really is the core? And we can future-proof our business by outsourcing things that are non-core to a firm that can do them at scale and frankly help us potentially execute our business strategy better and faster than we could otherwise do on an internal infrastructure. And what I mean by that is if a firm, let's say a firm is investing in, they're a UK-based firm investing only in European equities, that's what their systems are geared towards, that's what their people know. And if they decide that they want to get into new, more esoteric products like derivatives, sophisticated fixed income, they may not have the people or the systems to do that. And so they're looking at an extended period of time and considerable capital to enable those capabilities, where if you outsource to a provider like Northern, theoretically, we can handle any asset class. We're in all three major jurisdictions around the world. So the strategic value of this really is the ability to execute your business strategy faster and better than you otherwise could. And that could be anything from launching more product faster to expanding globally. So there's different layers to the value of these outsourcing pieces. One is the operational value, which is clients pay us to provide, strike the nav or do performance and analytics. But the strategic value really is in future-proofing the business model and being able to scale up and down, both from a cost perspective, but also from a capability perspective.
You've touched on a point I want to dig a bit deeper into, and that's more calculating net asset value.
Yeah.
I think in a very not expert sense, it doesn't seem like such a big task to do, right? But I guess it comes with the complexity of the product. So why is it so hard to do that and to outsource it? Because usually what do you outsource? You do complicated things that experts can do better. So what's the complex part about those services?
Yeah, it's not just the calculation of the NAV. That can be complicated based on volumes. Sometimes it's heavy trade volume. There's a timing aspect to it to be able to gather all the information that's needed to calculate the NAV, cash flows, prices for the underlying securities. There's dividend payments and capital corporate actions, things that happen that all have to be accounted for in a very timely way to be able to meet the daily deadline for publishing the price. But fund accounting and fund administration goes beyond that as well. So we provide financial reporting, for example. So mutual funds are technically public companies. And so there's heavy duty regulatory reporting as well as financial reporting for the shareholders and to the regulators. And then we provide regulatory administration as well, where we'll facilitate the quarterly board meetings that the board of directors of the mutual fund will hold and provide a lot of the underlying information associated with managing and reporting on the mutual fund and the governance around that.
I just read a book about the man who solved the market, and they're talking about those hedge fund managers. And they mentioned also Bernie Madoff. And I was then thinking, how can scams happen? Would that happen if they outsource? Is this like a company that would typically outsource all those calculations, or should it not be then obvious to the outsourced company that there's something going wrong? Or would he then do that in-house or pretend to do this in-house to be able to fool people? It was just something I was personally interested in.
Yeah, I mean that's a good question, and it's a long a long discussion. But look, as a result of what happened with the Madoff situation, as well as other misgivings, if you will, in the industry, and what happened in 2008 in terms of the global financial crisis, there's been a lot of regulatory change, specifically designed around investor protections. And we, as a large global trust bank, work very closely with the regulators to ensure that we implement the controls and checks that are, one, mandated by regulation, but two, that certainly our clients expect to help them ensure appropriate governance as well as compliance with global regulation. And so, as a result of Madoff and other things, we do advanced checks. We're consistently reconciling positions and confirming valuations of the particular securities. But in certain instances, if there's a will, there's a way in terms of greed and misgivings and misdoings. But we're comfortable that we've got a very robust set of controls and analysis to help identify any situation like that.
Yeah, it also seems to me that if you would insource such things, it's way easier to manipulate than to outsource it to another party that puts their reputation at risk if this somehow goes wrong, right?
Yeah, and that's that's a really good point. I mean, look, we're well known as being an extremely conservative global bank, and so mutual fund companies and other asset managers take comfort in having our brand stamp on their prospectus, because it does give validation that there's a firm behind it that is committed to appropriate valuation.
Perfect. I want to also dig a little deeper into custodian services. Could you tell us what would include custody services that you do?
Yeah, I mean, it's a range. I mean, custody is kind of a range of services. The pure custody is the safekeeping of assets. So we, cash and securities. So we're the official book of record, if you will, in terms of, let's just use cash, for example, how much cash a firm actually has on any given day. And there's lots of, inflows and outflows of cash, and it's a fairly sophisticated set of calculations and tracking that happens. And we publish every day. We are the official book of record. That's sort of pure custody. But then there's the accounting side of custody and the valuation. So let me give you an example. So a fund manager that's got a mutual fund will custody their assets with us. We provide not only the net asset value from a fund accounting perspective, but we provide, if you will, a mark to market, which is a valuation of the total portfolio. And that's the numbers that we provide are the official numbers, the official book of record from a legal perspective of the total valuation and the total positions and holdings of that particular fund. And then through the custody services, we do other things. I mean, we'll provide overnight cash and lending. It's a broad array of capabilities, all meant to serve as the official book of record for what is actually owned and held by that particular fund.
This also already dives into a topic I want to put a bit in the back for later. That's this blockchain, because I think that's kind of what you also might be looking at, because blockchain is supposed to be a book of record. For the moment, I have one slightly particular question. I spoke with a friend the other day, fund manager, and they say that their performance reporting often is very arduous to explain to the client, because if a particular security is not settled the proper day, it's very difficult to do the reporting right. So you might end up in a fixed income fund the middle office couldn't settle the trade in time, so the performance is dated a bit different, and then you'd have this sudden jumps in, for example, duration in the reporting to the client. You have to explain this. Is this something that you see, and how could you mitigate those errors, for example, in the reporting that are not particularly errors, but they still do a misreporting of a certain KPI?
Yeah, that's a good question. I mean, I'm not a detailed performance analyst or expert. I know enough to be dangerous, but the way that performance is calculated really is variable, right? And it could be either, if it's done on a settlement date basis, that's different from trade dated performance. So trade dated performance doesn't take into consideration the settlement. It's the actual trading values of that day. And so errors do happen and things do happen. In most cases, what we'll do is we'll just restate the performance calculation the next day or intraday if we catch the error. But what happens is those errors get corrected, and over the course of a month, you end up with a clean sort of end of month reporting and valuation set of performance numbers. Where it can get complicated with clients, though, is, there's a difference between straight performance measurement, which is a calculation of returns at the individual security level. But then you can also look at performance attribution, which is more defining and explaining where the actual performance came from and where the contributions to the return came from in terms of portfolio manager decision making.
Historically, which kind of companies would outsource, and is there a trend towards outsourcing from different industries?
I would say this, that the asset managers, traditional asset managers, are probably ahead in terms of the level of outsourcing that they do and their comfort and history with outsourcing. Hedge funds behind that, and hedge funds are obviously quite sophisticated, but in a lot of cases they'll still do the fund accounting in-house, and then they'll hire us to do it on a shadow basis as a second check. The private equity space is interesting. They're further behind in terms of their understanding and acceptance that outsourcing is actually viable. So a lot of the private equity firms, particularly in the US, still do their administration and accounting in-house, but we're seeing a trend towards growth and accelerating acceptance in the private equity space that providers like Northern can actually do their back office functions.
How would that work for a private equity company? Because I feel that, of course, a specialized expert that only does those outsourced services for a large mutual fund makes total sense. But if you only have very few assets, like in a private equity fund, maybe you have 5 to 10 portfolio companies, and a mutual fund has 500 to 1,000 so-called portfolio companies or investments. Is the low number of actually assets that they are holding, does it make it easier, or does it make it more complicated, or where's the value to outsource that on scale?
Yeah, it's just different. I wouldn't say that it's easier or harder. It's just fundamentally different, as you point out, from a traditional equity mutual fund. So the way that we've organized our business is by clearly defined client segments. So we've got a hedge fund business, we've got a private equity business, we've got a traditional asset manager business. And when I say business, I mean asset servicing business, all part of the same organization that I run. But we're highly specialized by client segment, by design, to ensure that we have the right expertise up and down that client segment. So take private equity, for example. We've got a dedicated private equity sales force that understands that space, speaks the same language, if you will. Our relationship and client servicing team, same thing. They've got private equity background. And then from an operating perspective, doing the actual accounting work and valuation, we've got specialist systems that have been developed for the private equity space. And we've got specially trained accountants who are well-versed in the private equity space as well. And there are different things that happen in the private equity space, things like capital calls. So the process is different, but we've geared up with, again, specialist technology as well as specialists from an accounting perspective that have that background.
You've jumped on a very good point, or a very interesting point, technology.
Yeah.
And I would like to circle back now to the topic maybe of blockchain or other technologies that are useful in asset servicing. Where do you see the trends are heading when it comes to technology?
Yeah, it's a good question. Technology is the key enabler for our business and really for the financial industry. So there are a number of trends happening, and the pace of this change is extremely rapid and fascinating from my perspective. So a couple of the big trends, one is certainly cloud and cloud enablement. We as a large institution are on our journey in the cloud, if you will, where we have several newer applications or technologies that are the first that we've had that are client-facing capabilities that are in the public cloud. And so we and other large institutions are going through this sort of cloud transformation to cloud enable where it's appropriate, but at the same time managing the risks associated with the cloud as it relates to data privacy, cyber, et cetera. So it's an interesting transformation that many of us are going through. So cloud is one. The other is we're all, focused on this quote unquote digital transformation. And one of our key objectives as a corporation is that we know we have to be a digital company. And saying that, what is a digital company? You'd probably get 20 different answers if you ask 20 different people. But my interpretation of it is a couple things. One, digital as it relates to the client experience. And so a lot of effort is being spent and capital on our side to enhance the client experience. So we're working a lot in concepts like human-centered design, which ensures that our user applications and the user experience is very intuitive, is ergonomically great from a distribution standpoint, is flexible, whether it's being able to communicate to mobile devices or send out ad hoc reports through files and APIs. So that's one aspect of the digital transformation, if you will. The other is that we are under cost pressure just like the rest of the industry. And so from an efficiency standpoint, a lot of effort and focus right now is going into the concept of digitizing the work, right? So rather than hire more and more people as we continue to grow, we're trying to further digitize the work and automate. And so a lot of effort is being spent on that, but also evaluating new and emerging technologies that can help us with productivity gains. And so that's a big part of technology disruption, if you will, or focus. Another area, which is still fairly nascent, is you mentioned the term blockchain. That's an area that we're investing in as well. And in fact, we were the first to roll out the first public blockchain in the private equity space. And we did that because the private equity space is frankly still manual and bilateral, if you will. So by having a digital ledger in the private equity space, any constituent in the private equity model, so the private equity firm themselves, auditors, lawyers, et cetera, can all access the same digital ledger and be a node on that ledger and create considerable efficiency across the process, because historically it's just been documents flying back and forth and edits and all that. In the blockchain model, it's just real-time sort of digital ledger. And so we were the first in that, and we're constantly evaluating through our innovation team where else blockchain may or may not be a disruptor and create some of the efficiency that we're trying to gain. So that's another big one. And then, there's this quote unquote fintech revolution where there are just a tremendous number of smaller nascent tech companies that are emerging and frankly that are well funded through either the VC or the private equity channels, and really smart people developing really cool technologies. But I would argue in a very fragmented way, in that a lot of what's being developed is really cool technology, but either very asset class specific or functionally specific. And so we're constantly at any given time, we're evaluating and doing pilots on some of these newer technologies to see what their use might be to us, for ourselves as a bank, but also for the benefit of our clients. We are very connected into Silicon Valley. In fact, our CIO sits on Silicon Valley Fund. And so we have transparency into a lot of these new emerging technologies. And as I said, constantly evaluating whether or not we can use them for us or for our clients. And then we're also looking at them from an investment or acquisition perspective. And so we've acquired a couple of small fintech companies over the last several years, which has really helped us because, again, really good technology, really smart people, relatively small companies, so not hugely difficult to integrate into our operating model. So I think you'll see firms like ours probably be a bit more acquisitive of these fintech plays as we go forward and the industry continues to evolve.
Can you give some examples on what emerging technologies might be helpful in an asset servicing environment?
Yeah, absolutely. So and this is public information, so we just acquired or taken an investment in a small fintech company called Paralux here in the US. And it was a net new capability and technology that we just didn't have at the bank as a custodian. And it's very sort of does a complex set of things, but basically it's a record keeping system for alternative asset managers. So alternative assets are investing in things like hedge funds, limited partnerships, infrastructure funds. and they're not real physical securities. There's no shares. It's a makeup of underlying positions. So what that system allows us to do is to not only track the single line item, that fact that call it a university endowment owns a single line hedge fund. We're actually going out and sourcing the underlying information, the underlying positions that make up that hedge fund through lots of different sources. And we can load those underlying positions into the system and then run very sophisticated performance and analytics such that the CIO of the chief investment officer of that fund can actually evaluate their portfolio versus the policy, and in consideration of very sophisticated performance and risk analytics, but also in consideration of the underlying positions to calculate things like total exposure. And so the idea of doing these acquisitions is really speed to market. For us to have built that system would take years and obviously considerable millions in terms of capital. So speed to market wise, we get ready access to that technology as well as, and just as importantly, the intellectual capital around it and the brain power for these net new capabilities. So it's really a speed to market play and capability play, obviously.
Yeah. I was wondering, I read in one article that you use robotics in fund accounting.
Yeah.
I'm lacking the imagination to see how robotics would help that. Can you shine some light into how robots are used in accounting?
Yeah, I'll do my best. Yeah, it's interesting. So here's the story. So we, as part of, as I said, our drive to get more efficient and quote unquote digitize the work. What we did 2 years ago is we set up a lab, quote unquote lab, an innovation lab within the fund accounting organization. And our fund accounting organization, just to give point of reference, is probably somewhere between 2,000 and 3,000 people around the world. So it's a big part of what we do. And so it was a logical place for us to look to say, okay, given new technologies and new ways of thinking, what can we do to make this fund accounting process more efficient? So we created this lab, and in the lab, we put a handful of fund accountants, but we matched them up and paired them up with experts in robotics as well as experts in agile methodologies, right? And we set a goal of saying, okay, let's try to get 100% more efficient as measured by how many funds a fund accountant can calculate the NAV for on a daily basis. And so we did that lab for a year, and again, wanting to get 100% more efficient. So let's say a fund accountant was able to do 5 mutual funds a day in terms of calculating the NAV. The goal would have been to be able to do 10 at the end of the year. And to be intellectually honest about it, we did put easy funds in there, index type funds that theoretically don't require a lot of hand holding because they're equity straightforward. And we did get 100% efficient. We did hit that 100% efficiency target over the course of the year, but importantly, and we did use robotics. So we have a center of excellence, and we use a tool called Blue Prism, which is third-party robotics. As we analyzed over the course of the year how we got 100% efficiency gain, we attributed about 25% of that to robotics. And so let me give you a very specific. So what robotics can do is, for example, they can take 2 data sets, because we use lots of different systems to calculate the NAV. They can compare 2 data sets, and if the data set matches and is reconciled, the robot, if you will, can literally sort of log into it. It has a login. It can log into another system where that data needs to go and load up that data. And so they're fairly straightforward routines that the robots can do, that if it saves a minute here or 5 minutes there on a cumulative basis can have, create a meaningful increase in productivity. But what was more interesting to me was that, as I said, 25% roughly was the gain from robotics. But what was more fascinating to me is that the balance of the efficiency gains were really more about the people dynamics. And by that, I mean, what changed was that historically, the fund accountant's job was to strike the NAV accurately and on time each day. I mean, it's more complicated than that, but that's the core of what our clients pay us to do. And by creating this lab, there was a just complete paradigm shift that striking the NAV became table stakes. The fun of it became, how do we get more efficient by being agile, by using robotics, by rethinking the process? And more importantly, the fun of it was, okay, how do we break new records, right? Last month, we were 25% more efficient. This month, we're 30% more efficient. And so it just changed the paradigm and the nature of the job from simply striking the NAV to, okay, the real mission here is how do we continue to do it well and accurately, but get faster and higher quality. So I guess that's not all that surprising, but it's informed a lot about how we think about the job of fund accounting and the inspiration and impetus behind change. And so technology will enable it, but obviously it's people with different skill sets and different perspectives that will allow us to leverage that underlying technology for continuous improvement. So sorry, that was a long answer to your question, but hopefully that made sense.
It absolutely made sense. I think it made things very clear. Is there a particular skill or a particular skill set that young people would need to go into the asset service industry? And actually, why should they? I think that would also be very interesting to our young listeners still thinking about where to go, where to find a way in the industry, what skill sets do they need, and why is asset servicing interesting?
Yeah, it's interesting. That's a great question. And I will say before I answer the question directly, I'm also involved I serve as chairman of the board of an industry association. And a big part of what we're trying to do there, mainly from a diversity and inclusion perspective, but more broadly is to do a bigger reach out to, and I'm focused on the US, but to higher education, universities, colleges, et cetera, to better educate the students on what this particular industry has to offer, because it is incredibly diverse in terms of the opportunity set it provides for people of all backgrounds, right? I mean, I was a marketing major, but this industry is the largest consumer of technology by a considerable margin. So there's a massive technology opportunity. There's data science opportunities. There's, obviously the portfolio management, financial aspects of it. So it's just an incredibly diverse business. But so why would graduating seniors or try to get into this industry? I think it is because of that diversity and because of the long-term sustained nature of the business. I mean, this is all about the investment or preservation of capital, ultimately for individuals. We have institutional managers, but at the end of the day, it's really about individuals and their well-being and the safekeeping of their security. So, sometimes it's hard to make that connection, but we, as a principal bank, we're constantly reminding ourselves of the ultimate value that we're providing. But what kind of skill sets do students need? I mean, again, because it's so diverse, we're really looking at a wide range of, I've got folks that work for me who were philosophy majors. I've got others that were, obviously finance and economics majors, English majors. So it's not so much about that. Really, for me, it's the willingness to learn, intellectual curiosity, having a good motor or being motivated, depending on what you want to do. Certain types of roles obviously require a more specific background. But more importantly, what's changing now is that I can tell you statistically, I believe last year that 75% of the people we hired as a bank last year, and I don't have the exact number what that was, but I'm guessing it was well over 1,000, were millennials. And we've got 5 generations of workforce here at Northern. So it's really an interesting time. And, given the role that I have, I'm constantly evaluating and thinking about the future and about the nature of the work that we do and this next generation and how they want and need to operate and work. And so that informs a lot of my thinking about, okay, what are the skill sets and it's, skill sets, hard skill sets and training are one thing, but actually I'm pretty focused on the softer side of things as well in terms of, are the folks that we're bringing in, are they intellectually curious? Are they problem solvers? Because we need that as well. And so also looking at bringing in skill sets that we haven't historically had in areas like the cloud, data science, artificial intelligence. And that's been really interesting as well, because it's really important for us to not only bring that new talent in that has a different perspective and experience set, but to actually give them a seat at the table to help us, help identify or inform on what's even possible and ensure that that thinking gets included in our strategy. And and so I work very hard to try to not get caught up in the perils of ageism or titleism, right? And by titleism, I mean executive vice president, senior vice president, where we've got to engage this next generation and really leverage their capability and knowledge. And that's been a really fun process for me. I mean, it's ongoing, but it's been really interesting and fun.
How do you ensure that you attract a diverse set of people, of skill sets? I'm thinking with another podcast, we had the topic of women in finance, that there are very little women in finance, but there are also very little women interested in finance or of other diverse people interested in finance. So you said you have philosophy majors. How do you make sure to create a work environment that attracts people from any kind of field or any kind of interest?
Yeah, I mean, that's a really good question, and this is something I'm quite passionate about. And I serve, as I said, I serve as chairman of the board of an industry association called NICSA, and there's another part of NICSA called the NICSA Diversity Project, which is just established in the last year, and it was established by 30 founding members, of which Northern is one. And there's 29 other large financial institutions in the U.S. And I'm fortunate enough to serve as the co-chair of the CEO Advisory Council of the Diversity Project. And so the mission there, and I'll bring it back to what we're doing at Northern, but the mission of the NICSA Diversity Project is really twofold. One, to get like-minded firms together to actually share best practices around diversity, equality, and inclusion. And more importantly to me, is trying to move the needle, if you will, and change the brand perception of the financial services industry in the U.S., which is that, it's run by white males, Wall Street, greed infused, all of that. And whilst, in historical context, that brand reputation has probably been earned, as I said earlier, the unfortunate part of that is that this industry is incredibly diverse and has an incredibly diverse opportunity set for people of all backgrounds, right? And by backgrounds, I mean, it doesn't matter, gender, race, ethnicity, but it also doesn't matter in terms of, it provides an immense opportunity set for people with different educational backgrounds as well. Technology, as I said, marketing, finance. So part of the mission of the Diversity Project really is to engage with higher education and universities to better educate students on what the industry is all about and what that opportunity set is, under the hopes that the long-term answer to the diversity challenge in the industry is really getting the next generation of diverse talent to have an interest in the industry and to actually engage in the industry. And so early days for that particular initiative, but I'm very pleased and proud to be part of it. And I'm hopeful that we'll be able to have a positive impact as we take things forward. Now, in terms of what we do here, I mean, it's interesting because when I look at diversity and equity inclusion, or equality and inclusion, what I'm trying to do as a business leader is not just do it because it's the right thing to do, which it is, but I truly believe that a more diverse workforce will be higher performing, more innovative, certainly, and just frankly, a more interesting place to work. So we're trying to put that into real practice. And I'll give you an example of what we're doing. So we have a series of business resource councils at Northern. So we have a Black Business Resource Council. We have Women in Leadership. We have Asian Heritage Resource Council. And these are obviously affinity groups that get together and do really good things and host lunches and talk about best practice. But what I've done in my business is I've got, see a series of direct reports. So each of us has sort of quote unquote owned one of these business resource councils. And the objective there of this ownership, if you will, is to make sure that our business is engaged with these resource councils, and partly for selfish reasons, for recruiting, to understand where the talent is around the bank. But more importantly is to actually engage with them so that we can understand and celebrate the diversity, the cultural differences. So for example, I run the U.S. side of the business and I'm based in Chicago and we're in the holiday season now. And so everybody's walking around saying happy holidays. And if, I know someone's Jewish, I'll say happy Hanukkah or Merry Christmas. And that's all great. But we've also got a huge Indian contingent of partners here at Northern. And, they have obviously large holidays as well, like Diwali. And so whilst this sounds simple, we're trying to, so for example, we're hosting a luncheon where one of our Indian partners is going to come in and educate us on the Diwali holiday and what it means culturally. And so that, when that happens, we're not living in a bubble. We understand it and can celebrate in that with our Indian partners as well. So, and that's just one example. So really trying to own it and embed diversity and inclusion into the daily fabric of how we run the business, not just look at it to say, okay, here's our ratio of men to women. That matters too. But I'm trying to make it mean more than that.
Perfect. Thank you so much. Now, before we wrap up, do you have any last things that you want to speak about? Any last tips you want to give our audience, or any last shout outs that?
Yeah, no, I guess I'd reiterate for those that are, watching and are interested, but aren't, and are looking at this industry as a potential career move. I meant what I said. It does have such a tremendously diverse opportunity set. I feel very fortunate to have started in this industry, and I've, obviously had some level of success. And frankly, part of what I'm doing with the Diversity Project and NICSA in general is this industry has been very good to me, and I'm committed to doing my part in giving back, trying to drive some positive change. So, but I appreciate very much having me.
Perfect. Dan, thank you so much for your time. This was super interesting.
Thank you for listening to the Wall Street Lab podcast. For the show notes and much more, visit us at www.thewallstreetlab.com. To see what we're up to before anyone else, subscribe to our newsletter on our website and follow us on Facebook and Twitter.
Disclaimer. Information contained in this podcast constitutes the opinions of individuals and should not be treated as investment, tax, financial, or legal advice. We take no responsibility for the accuracy of any statements made in this podcast. This podcast is for informational and educational purposes only, and it does not contain an offer to sell or buy any sort of financial products, and should not be treated as advertisement for such. Any copying, distribution, or reproduction of this podcast without the prior permission of the creators of the podcast is strictly prohibited.